Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. For the next 20 minutes, we'll talk about obviously mutual funds, but whether the US election outcome has an impact on your mutual fund portfolio. I would reckon an impact, direct impact, would possibly be on the debt fund side, not as much on the equity fund side. Sure enough, if you had a tech fund, maybe you could contemplate keeping it or buying more. And I'll pose these questions to our guests who join me today, Kshitiz Mahajan and Kirtan Shah. Need no introduction, both of them. And thank you so much. Really appreciate you, both of you, taking the time out and joining us. And I know it's a fluid topic because by the time we decided we'll talk about this, the election outcome is now well known. So we'll kind of debate about that a bit more as well. And Kirtan, I must tell you that Kshitiz must be feeling really bad because he ran the New York Marathon about a week ago. He must be hoping that he would be in the US today as opposed to last week, but just such is the thing. But it's an astounding development over the last 24 hours. And I'd like to start with you, Kirtan, on whether, before we get to the debt part, would equity funds or equity portfolio of your mutual fund portfolio have any bearing or changes because of the US election verdict?
I think, Neeraj, first of all, thank you so much for having me on the show. A lot of this was already priced in, if I'm not wrong, because you saw the movement of FIIs taking the money out first. The discussion was around how China is undervalued. And over a period of time, I'm sure all of us, when we looked at the data granularly, we understood that a lot of this money is moving back to US already, right? Because of the net inflows, outflows for October in China, it was quite apparent that a lot of this money, yes, did initially go to China, but a lot of this is moving back to US. So I think that whatever we've seen as a market impact on India over the last 1 month because of the FIIs moving out, most of this is already priced in, and probably you might have a near-term impact because outside of this macro, you also have a couple of elections that are extremely important in India coming up. So maybe November may be a little macro event driven for us in that sense, but I don't really think outside of this so smaller impact that we probably might even see in November, it really will have a very large bearing on India equity as such.
Mm-hmm. Kshitiz, firstly, of course, congrats on that marathon as well, probably the third one. I'm sure you were wishing you were in the US currently, and maybe the marathon was happening this weekend or so to say, but congrats on that. I'd love to know your thoughts, Kshitiz, on whether you believe the equity portfolio should see some changes as a result of the US election outcome.
So thank you. Hi, Kirtan. Hi, Neeraj. And Neeraj, I'm in US only. I'm in New York. In fact, I went.
You are, okay.
They went to vote after their office, and here the vibe was very different. It was live channels, live open areas where this entire game is going on. Who's gonna win? Who's gonna win? And there's a time difference, 3 different time zones here. So it all started from Eastern Coast, and then how this entire thing has panned out. So there are different set of people who are thinking about how to go about it. But anyways, with regard to India, my submission here is there is no state, there's no change as far as our strategy is concerned. As a country, wherever there is an opportunity in terms of dip, we are asking people to top up, look at this as an opportunity, which if you have missed in the past while participating, and that's what we have seen. I echo what Kirtan has said. And I think broader, if you ask me, many people, if they're contemplating, and you started it really well on the tech side also. So yes, for the time being, in the short run, it might give you some kick, but yes, overall, the view can be personal. It can be really good for US as well as for Indian economy, because all this help and it pushes, because if you have someone who's running a business and he runs a country like a business, it always helps and gives a very positive mood to the overall sentiments. Having said that, I very sincerely feel that the type of returns we have seen in the last 3.5, 4 years, is a aberration of what has happened because of liquidity in the market. One can actually to start building their portfolio for long-term here onwards with a realistic expectation of return for markets, and that's the right approach while you approach your investment plan and goal plan.
Okay. Now, okay, Kshitiz, I'd love to understand from you, what about, by the way, it's really late for you, I presume, Kshitiz, so thanks for staying up, I presume. But what time is it currently in the US?
It's 3:10 in New York
Oh,
as we speak.
goodness. Okay. Thanks for staying up for us. Okay. Amongst other things, of course. So, Kshitiz,
Right.
what about the debt portfolio? I mean, there could be a change, right? Because Trump's announcements have been indicative of an inflationary trade coming back, and therefore the possibility of the rate cut trajectory that people had thought about or presumed may not turn out that way. In all probability, it will not. So what changes should people make to the debt portfolios that they may be having or maybe wanting to make in the immediacy of the next couple of months?
So it's been 8 quarters where RBI has taken a stance where they have not cut the rates, and inflation very much there in our comfort zone. At the same time, Neeraj, what we are looking at is that irrespective of RBI not cutting the rate, there's a movement of almost 45-50 bips on 10-year yield. So I think many people who are looking at it right now, India specific, we are due for a rate cut, but we were just holding our things back because inflation was little on a high side. But if you see, this is a time when you should look back that even in fixed income or debt portfolio can also yield double-digit return over the next 1.5 years. So if one has to take a call now, on the asset allocation side, and I presume that because after the market correction, many of the equation has changed now because otherwise equity portion was looking little high. But yes, still we are looking at on a long dated debt funds, we are looking at 50-60 pips of benefit, which yields to be, if you are having a 10 years plus modified duration, which yields to be almost 4 to 5% of kicker in the portfolio on overall yield also. So one can look at double digit return in fixed income also. So we are asking people to participate, and we are looking at that this is a time when one should put some money on a short term basis. If somebody is looking at it, I think there are also some juices there because almost the curve is flat if you see on the yield side of fixed income also. So I presume that taxation is not friendly as we speak after the new tax regime on the fixed income side. But yes, you can actually look at a double-digit return in next 12 to 18 months time from here onwards. So we are building position in fixed income also.
Okay, I'll want some specifics, but Kirtan, does your view differ here from what Kshitiz has just said? First.
Oh, absolutely not. I think, rate in India is going to be completely determined by India factors. If you see 50 bips cut by Fed in the past a decade back, India would have generally had moved, right? But you've seen that RBI did not go ahead and do anything because the focus is completely India specific, in my opinion. Right now, in spite of that, if you see inflation is under control, all the other factors that probably RBI is really looking at to go ahead and cut rates are moving in the right direction. We think that the next calendar year, we will definitely see rate cuts, even if the trajectory of rate cuts in the US have to go down. Apart from this, while rate cut might determine the short term or the shorter end of the curve, the longer end of the curve is already pricing in yield benefits, because outside of this, there is also a lot of foreign money that is going to flow in because we've got included in a lot of global bonds. So I think global bond indices. So I think tactically also this is definitely a space to stay on the medium or the long duration funds. And structurally also, I think rates probably will favor fixed income investors over a longer period of time. So definitely if you have an 18-20 month view, very good time for you to look at medium duration funds or long duration funds. And even if structurally you have a 5-year, 10-year horizon, I still believe that long duration funds will end up doing a very good job.
Okay, so let's try and simplify this. Okay, and by the way, let me try and get some specific ideas. Kirtan, let's simplify this. So what funds, I mean, if you can't give me the specific names, then the specific category that people should look at. Let's assume the investor who's watching us right now, she doesn't have any debt market investments currently, and she's starting her investment journey from this afternoon. What should she do on the debt side over the next 2 months? What kind of funds?
See, there are two ways of looking at it. First, if you are taking a tactical bet, right, that interest rates are supposed to go down, which is our view in the next calendar year, and you want to tactically allocate some money to fixed income, ideally you should look at some category called as medium duration funds, medium to long duration funds, and long duration funds. These are the three categories that you look at, because if rates go down in the next calendar year, which is the expectation, you will not only make the 7.5% as yields available today, but you will easily make 3-4% more than that. So you will be able to easily make 3.5-4% more than your fixed deposit returns if you invest in any of these three categories that I spoke to you of with a 18 to 20 month view. Let's say you are building a fixed income portfolio and it has got nothing to do with what is happening in.
No, Kirtan.
Yeah.
Kirtan, sorry. Can I also ask if you are okay with naming some funds? It may not be an exhaustive list, by the way. It may not be the only funds that you recommend, but some idea for people to take home from in this category.
Yeah, you can look at SBI medium duration. You can look at Nippon India Nivesh Lakshya. These are two funds that you can look at in the medium and the long term category.
Okay, now please finish your point. Yes.
So let's say if it is not tactical to do with interest rates going down, but this is more of building a very robust fixed income portfolio, then I think you should split your fixed income investments into three buckets. The first bucket is to do with liquidity, where you probably keep 6 months of your expenses as a contingency fund in liquid or money market. The second, where you keep 70% of your portfolio, right, which is to do with what your core risk appetite is. So if you are a conservative investor, you do ultra short term or money market or short term kind of investing here. If you are aggressive, you do a mix of long duration and credit. And in the last part, which is tactical, you do what I just mentioned, because interest rates are expected to go down. You take positions in medium duration, medium to long, or long duration funds.
Okay. Now, Kshitiz, what would your thoughts be? Again, the same perspective. A person doesn't have investments right now. She wants to start one tactical, two long term. I'm presuming the near term has a tactical flavor more in focus as opposed to the longer term portfolio. What would your response be?
So, Neeraj, what has happened? I think, first of all, I echo with what Kirtan is saying, but what has happened? That because of the tax benefit has gone away. So you really don't have to wait for that entire 3 years to get that long term with indexation benefit. Now that's not there. So one is that you have this short term, investment which is going in your portfolio around 20%. Then you can have a broader investment of 45-50% on medium term basis, where you can invest into medium term bonds, and then tactical long term bonds, which can give an immediate kicker next 18 to 20 months. And rather than just waiting on, if you see that entire cycle playing out, and just to make it simple, how the cycle will play out, people who are watching us, when they see the rate cut is coming and that rate cut is actually converting into the lower interest rates in the market, then you see that impact will come in the fund also. So there's a terminology called modified duration. Whenever you invest in a mutual fund, a fixed income mutual fund, you have an average maturity as well as modified duration of a fund, which tells you with every 1% kicker, what is the impact in the portfolio. So let's say if the modified duration is 10% in a fund, let's take example of Bandhan Gilt Fund. If I think it's around 11 years, the modified duration, then if 1% rate cut will happen, so you'll see there is a kicker of 11% coming over and above the coupon, which Kirtan was mentioning, around 7%. So you make, this is just a illustration, you make 17-18% return. If 50 paisa rate cut will happen, then that modified duration will turn out to give you a 5.5% kicker along with that 7% coupon which is there in the portfolio, which works out to be 12.5%. So now when you have this cycle playing out your way, if you don't want to invest for long term 5 to 10 years, then you can actually move back to a shorter end of the curve of fixed income. But if you have an allocation which is for long and you want to hold it, then you keep on getting the coupon which you are investing into. Let's say if it's at 7 years, 7% coupon, you keep on getting into it. So just divide between 30, 40 and technically 25-30% for long-term bonds. And you will see that in fixed income also, which is a very important part of asset allocation, irrespective of whether tax benefit is there or not, you'll be able to create a basket which can generate for you 7 to 8% overall return.
Okay, and Kshitiz, sorry if I missed it. Very sorry if I missed it, but did you give me some names or indicative names of some funds? Again, it may not be an exhaustive list, of course.
No, I haven't given. I think long term is Bandhan Guild Fund is there. Your Nippon Lakshya Nives is there. That's there. And then short term, we have a lot of option across ANC. Mid term also, we have a lot of option across ANCs. I don't want to name anyone, but there are a lot of options available, which is there.
Got it. Okay. Okay. I'd like to take a couple of queries if I can. By the way, both of you, thank you so much in a succinct way to explain this. Remember, viewers, it's not as easy as it sounds on TV. If you really want to play this well, maybe have an advisor advise you. But in the case you are a DIY investor, I think this gives you a small sense of what you can do, both tactically and slightly and from a slightly medium-term perspective. If indeed your belief is also that we may not see a rate cut but a rate hike trajectory, and of course, if you also believe that India may be slightly different than what the rest of the other central banks do, because we've somehow done that now over the past 12 to 18 months. Okay, some queries. The first one is from Bikash, age 33. Bikash says that I want to invest 10 lakh lump sum in a mid-cap fund. Please advise whether this is the time to invest or should I wait for some correction? And also, which fund should I go for? Kirtan, I'll come to you on this.
Because the first thing that I would really like to tell you is please have a 5-6 years of investment horizon if you want to do mid-cap investing. Also, please keep your expectations on the return significantly lower than what you've seen over the last 3-4 years. And I hope that's not the reason why you want to do mid-cap investing. And if both the things that I just mentioned are in sync with you, stagger your investments over the next 6 months. So ideally what you do is first invest in liquid funds and then systematically every week transfer money to the targeted equity fund over the next 6 months. Try not to do lump sum and try to time the market today.
Okay. Okay. The second question is from Anjum, age 57 years. Anjum asks, is this a good time to invest in US-based funds given that Donald Trump, his question was Donald Trump will win the election. It certainly seems like he is going to do that. He's given a victory speech as well. Kshitiz, what do you believe?
So I believe, tax again is not in favor of US-based investing. The long-term capital gain has been taken away. At the same time, Neeraj, what can be done is we always say that for US allocation, one can look at 5 to 7% of tactical allocation toward US markets. And, rather than investing into active funds, I think passive approach is the right approach. So one can look at broader index funds like NASDAQ or S&P 500. To invest into, and if you have a horizon, again, equity investing, irrespective of whether Indian equities or foreign equities, less than 5 years doesn't make sense, Anjum, because already at the age of 57 you are. So if you have 5-year plus horizon on your side, then you can look at participating into any of these index funds. But this should be not more than 5 to 7% of your overall allocation in your portfolio.
Okay. Ayas Chandra has the next query. Ayas is age 27 years. He's 1 lakh lump sum ready to be invested. Should Ayas wait for more correction and invest in Jan 2025? Pretty similar to the first question. So, Kshitiz, I'll come to you on this one. Should Ayas wait for a correction?
I think rather than waiting for a correction, we keep on talking on your show and many shows, and much more money is lost in waiting for correction rather than just being in market. So I think you should look at participating in equity market and just do 6 to 8 weeks STP rather than just waiting for correction. And better approach is look at a flexi-cap fund because and then just don't have this fund. If you, let's say, if possible, if you're done with your STP in next 6 to 8 weeks, just add SIP in the same fund. The type of kicker which you'll get with ongoing investing into the same fund, which is going to be very, very high. So one is do a 6 to 8 week STP in a flexi cap fund. There are 3-4 many good AMCs which are offering that. You can look at Kotak, you can look at DSP, you can look at ICICI, HDFC, all have good funds. And then just add a SIP in the same fund. And just don't have only one fund going with you. If you have some other fund, then it's fine. Otherwise, just maybe invest also, divide this into a couple of flexi cap funds.
Okay. Last question. Kirtan, Mahendra, age 36 years, asks thought on the Nifty India Travel and Tourism Index Fund. Any thoughts here?
Mahendra, very honestly, I'm not a great thematic or a sectorial investing fan. I would rather suggest that as a retail investor, you stick to core, having a large cap, mid cap, small cap in your portfolio than trying to be very thematic or sectorial. Because look, sectors are cyclical. There have been enough and more examples how for 10 years sectors have not moved and your portfolio has been negative. So unless you are a professional investor, understanding this space and you know specifically when to enter and as good as when to exit, then take sectorial bets. Otherwise, I think more diversified funds is a better way to invest.
Noted. Okay, well, gentlemen, both of you, thank you so much for taking the time out and being with us. Kshitiz, have a great remainder of the day. Rather, Kirtan, have a great remainder of the day. And Kshitiz, please go to sleep. Good night. And thanks so much for waiting by patiently for us on this show. 3 a.m. or 3:30 a.m. in New York, quite something. But thank you so much, both of you.
Yeah. Bye.
Thank
Bye.
you so
Thank
much.
you.
All right, and viewers, thanks for tuning into this edition of the Mutual Fund Show.